All right. It's the weekend, and I am working on another playbook, and I think this is one that is worth doing a video on because I could use another rep. And I think this is the type of opportunity that could be, a significant add to cash flow in the year, especially if sized right. So we're going to talk about a market play in the QQQ index, April 3rd and April 4th, because actually, if it was traded at right, it would have been a swing trade. So not typical kind of intraday SMB trade, but I think there is a lot of SMB style in here, so it's worth discussing and absolutely playbooking and learning from. So bigger picture, after making new highs in the indexes or in Qs, it failed. Pretty significant, deep, fast, hard retracement, like less than 20%, but pretty close. Consolidated for a number of weeks, pushed up, kind of retraced this big move by almost 30%, and then kind of consolidated a range near the lows, kind of tried to push up, and then failed below the lows of this consolidation, opening up more downside. So we're going to talk a lot more about this because the play is in the Qs, but the bigger picture is a pretty bearish environment, a lot of fear about tariffs and about a potential recession, and that leads us into that discussion. So this is the day of the trade. We had elevated VIX, almost 30, put the market in play. And then the night of this trade that we're talking about, potentially holding it for the gap and continuation, we gapped up into the 40s and held above basically 35 all day on the VIX. So quite a high volatility environment, not something we're been trading in a lot recently, and not a lot of experience that I have in it because I've been trading for less than 2 years. So part of the reason I didn't fully optimize this trade, and the reason I'm studying is I'm trying to learn how to trade more effectively and efficiently in this high volatility environment. So a little different intraday fundamental slide. I'm not sure we need to talk about the float on the Qs and all that good stuff. At the end of the day, really the biggest measurement on this index, market trade, was that RVOL on day one was 1.4, which is huge. As we talked about before, the Qs are a very liquid instrument. So like an RVOL of like 1.1 is probably significant because it's 10% more than an already, big trading day. But the first day was 1.4. And on the second day, the continuation day, it was 2.5, which is massive, massive volume on the Q. So this is very in play. So on the day before this trade, really the night before, President Trump announced tariffs that were much worse than expected. This is a significant macro catalyst, causing big money to have to reposition, including the closing of long positions exposed to tariff risk, as well as the opening, for hedge funds of new short positions. So significant pressure on the market, and this is a 10 out of 10 catalyst. So in terms of the setup, now looking at the Qs again. So, we drove up to highs, and we had the low of the 3-week consolidation, like 465. So we ripped down pretty hard sell, and we consolidated for 3 weeks above, holding 465. You can see the 450 level, which becomes super significant, was also support. Back when we sold off in August, we had a hard sell down to like 425. We, pushed back up, came back down, found the lower high at like 450. And 450 was also resistance back here earlier last year. So 450 is a significant level, as is 425. And we will dive deeper as we drill down into other time frames. But at the higher time frame weekly level, you got the 3-week support, you got this 450 level, and you have this 425 level, which all become important in this trade. So drilling down to the daily chart, you can see how well this 465 level held this consolidation, which lasted 3 weeks. The The 425 level you can see was support. 450 was support back here in really April, May of 2024. And also, this was kind of the bottoming point when we had the yen carry trade unwind. We pushed down here to 425. We made a intermediate high, and then we made a higher low at 425 and held that. And it was support for 1, 2, 3, 4, 5 days before pushing off and really continuing on this rally that brought us up to all-time highs. And so that's a pretty significant level. And like I said, it's supported there for, 2 weeks or more, including this test. So that 450 level is pretty significant. So we drop down to the hourly, and this doesn't have the overnight on it, which I think is fine. I think it actually cleans it up a little bit. But you can see going into this tariff announcement, we had 3 days of pretty significant buying in the Qs. So people were positioning long, thinking that Trump would resolve a lot of the tariff risk, that things would be better, and that potentially that bigger picture situation here, that we would just kind of rip up to all-time highs because things would be good. Things were not good. The announcement was far worse than expected. Broad-reaching tariffs across a number of companies, the potential for a trade war, really kind of a worst-case scenario. And we gapped down pretty big time on that move. But we found support, a little bit above 450. And we started to drift down 450 on the hourly. And then we're going to talk about this part, which is kind of that day 2. Day 3. Yeah, it's day 2, right? So we digested, had another big gap, and kind of closed at the lows. So on the intraday, getting in a little more detail, the day of this trade, right, we opened up in the 15. We ripped down. We hit this 452.60, 452.50 level. Found buyers, made a higher low, sold down, hit that 452.50 again, making a double bottom. Maybe some people thought, hey, this is it. We're going to turn on this tariff news. Found some buyers. Volume came up a little bit, but it didn't work, right? We broke that uptrend and we flushed into the close. And then we gapped down, which we'll talk about. So on the intraday again, kind of zooming into like a 2-minute chart. Same thing here. We got this double bottom that we were talking about here. Maybe this was a little bit of a higher low. When we get it more granular, we kind of bled through that 452.50 level. So you could see that people maybe thought, you can see some buyers stepped in kind of higher volume than we've had in a while, thinking, okay, this is it. We're going to have that reversal. We're going to buy into the close. It's all going to be fine. And nope, it was not fine. We broke that uptrend. We retested it, and we failed pretty hard and ground down into that 450 level into the close, which we were not able to break. So, my trade idea was that we would be able to break 450, which would lead to significant downside. And I was also looking for this last 30-minute trade. And I really looked this as a day trade, trying to get into that 450 level, that we would at least test it if we couldn't, hold that uptrend. So here's how I exercised this trade. Which, brought the bigger trade idea and the reason for this playbook, which is I bought 450 puts for the next day. So this was Thursday. I bought them for Friday, thinking, hey, maybe I'll hold some. We'll see how this plays out. But I didn't want to get killed kind of as we go into the close with time decay. And even if we didn't get to the 450, if we were at 451, they'd be really not worth a ton. And so I really wanted to see kind of the ability to have an exponential move in the option. And so I bought 5 contracts as we broke below this consolidation. We had really good momentum, and I sold 5 of them. And I sold them too early. We'll talk about it when we talk about the options pricing. And then, it looked to me that we weren't going to close below 450. There was significant buyers at 450. Option prices kept kind of squeezing up off 450. So I kind of pieced out my remaining position before the close, and had a little bit of, kind of fear of, holding these overnight, because in other trades I've been gapped up against with options, and it's just not pretty because I take a winning trade and turn it into a, either a break-even trade or even a losing trade. And, this was a different scenario. This is an A catalyst. We're breaking a significant level. There was a reason to hold these. So let's talk about kind of how it played out. So this is the price chart for the actual option. I didn't put like the whole long symbol, but this is basically QQQ 450 put expiring 4425. This is 44325, and this is 4425. So you can see I entered as we were spiking up, and I bought them at $2.25 a contract, and I was willing to risk $2 a contract. And we'll talk about the numbers here. Why not? I bought 10 contracts, so I was risking about $250. I sold 5 of them at $3. We had a really kind of a quick exponential move. I was allowing kind of the results. Took some paper cuts kind of coming into this on this kind of move up here, which was like this down move that never actually really went into 250. I thought we'd fail from VWAP and make it, but we had an additional push. And so as we pushed up, I got shaken out. I sold them. So I took a small loss going into this trade. And so honestly, I was thinking more about recouping my loss and fearful that we weren't going to see continuation, and thinking that this was just another trade versus like the A setup it was. And so I sold 5 at $3, which kind of like recapped my losses from the previous. And I hold the other 5, and I kind of pieced them out when we started to run into issues breaking that 450 level, because I didn't even hold the one. Which you can see with the gap up, we went from a close at $4 per contract to, basically open up at 12 and closing at 28. So given the significance of this catalyst, I would absolutely manage this trade differently. So let's talk about how I should have managed this trade. So I obviously enter long 10 contracts, same thing. What I should have done is I should have sold 5 of those contracts, like literally right into the close, because we broke $4, which basically would have covered all the cost. Actually, it would have left me with $250 risk. So it would have left me with the original risk. Because basically, if you look at the math, you're into it for like $2,500 worth of contracts. You sell 4 at 5, you sell 2,000. So you have that original $250 risk basically uncovered. And even if this thing gapped down and just destroyed you, the most you would lose is 250, because those options contracts would go to zero, but you already made $2,000. And again, does that make sense, right? You paid $2,500, you sold them for $2,250, you sold them to $2,000. You owe $500, but you still have 4 contracts. So if it goes zero, it's nothing. So then you have 2 options about the exit here, right? If, and this is a catalyst where you can believe that we're going to close it low a day the next day. We're not going to find buyers for this, or we shouldn't. And even if you do believe we're going to find buyers, we at least have to find them, right? So we bought up at the open, we sold off at the open, had a spike in the value of the contract, dipped down to the opening price of the contract. Still, we're sitting like well into the green. We could either sell into this failure at the highs of the contract price, which was like the mid 20s, or we could just go to the beach all day and say, you know what, this is paid for. Like it's not going to lose any money. Let's just see what happens. And if we did that, we would have sold them into 25, 26. If you sell them into this spike, you have a 48-1 risk to reward on your $250 original risk. And if you hold them for the end of the day, you have a 56-1. This is absolutely the type of trade, especially if you size up, that you could make a living off of. I mean, even this, like a $250 risk with 10 contracts, the reality is if you sell it into here, you're like $10,000. And if you sell it into here, you're like 12 or 14 on a $250 risk. So definitely an opportunity. And, the market is an endless flow of opportunities. So let's talk about the learnings here. So what did I do well on this trade? Well, I had a good entry, and I used an appropriate instrument and strike price. So I'm really happy about the selection that I did of the 450 puts. I used the right timing. I pushed him out a day to let him, give the opportunity for the swing. And, trading this through options was absolutely positively the right call. When you look at the risk to reward and the exponential pricing change of options as they go through the strike price and into the money, you're not going to get 48, 50 to 1 if you're doing this with equity. What I learned from this trade is, we've been in a range, we've been selling off, a lot of things have failed, a lot of gap trades haven't been good, but it doesn't matter. What matters as a trader is my ability to recognize those setups that are far better in risk to reward and opportunity and probability than other setups. So even though things haven't worked, this is the one that worked. And by not identifying that this was an A catalyst and an A setup, I sold it for a small profit. I made $1,000 on this trade instead of making 10,000, 12,000, right? On a tiny little position, which, if you're taking $2,500 in risk, that's $100,000 profit in this opportunity. And that's totally doable, even in my account size. So I need to improve my ability to recognize an A trade from just a good setup but I could have taken this one contract, right? So I need to differentiate. That's what I learned. How could I have done this better? I could have swung 50% of the trade risk free. I would have lost $250, $1 hour, no big deal. How would I trade this differently next time? In the future, I would like to trade this with a lot more size. I think next time I honestly wouldn't trade it with more size because I'm still learning, and it hurts a lot more to fail at bigger size as an independent retail trader, and it can put you out of the game. So there's no reason to really size this up until I can do it effectively. So I'm recognizing it, but I did not do it effectively. I didn't even do it at small size, right? I made a couple mistakes, and I would sing or swing the 50% with $250 risk. Absolutely. Every time, when I see a setup like this, that's what I need to do. As Bella says, you need to swing the bat hard. So I think this is an A+ setup, an A+ trade, and an A+ way to exercise it. I give myself a C for execution, maybe a D. But I give myself an A for recognizing what it is and really taking as many reps as I can to do this right. And even if it takes a year, 2 years, 3 years to get this type of trade right, this is a type of trade that you can make a living off, even if you see it 2, 3, 4, 5 times a year. And it doesn't have to be the index, right? This could happen with an individual ticker where things just change radically. We're going to see the same type of price action. We've seen this before with SMCI. We've seen this before with other tickers, PLTR, where there is a changing fundamental catalyst that drives massive change in the stock price. And this is not the average. This isn't a B trade. This isn't a C trade. This is an A setup. So anyway, that's my thoughts. And I'm going to keep trying to get better each day. But I think getting these reps and talking about this out loud really helps. So hope anyone who actually takes time to watch it enjoys.